Welcome to The Explainer. Today, we're unpacking a really fascinating mystery in the market. Applied Materials, which is an absolute powerhouse in AI manufacturing, just reported literally the best quarter in its entire history. I mean, we are talking record-breaking numbers across the board. But instead of the stock soaring, it actually took a dive.
It's the ultimate Wall Street paradox, isn't it? They post these absolute blowout numbers for their August 13th fiscal Q3 2026 earnings, and the market rewards them with a 5% stock drop. So what exactly is going on here? Is this a rare golden buying opportunity for a fundamentally strong company, or is it a glaring warning sign flashing red? Let's figure it out.
Let's start right with the facts, and honestly, they are staggering. Revenue hit $9.12 billion. That didn't just beat the $8.9 billion estimate, it completely crushed it. We're looking at a 25% year-over-year increase. And the engines behind this? A record $7 billion in their Semiconductor Systems division, plus another record $1.8 billion in services. And the bottom line was just as impressive. Non-GAAP earnings per share hit $3.50, comfortably topping the $3.40 consensus. And if that wasn't enough, their gross margins expanded for the 13th consecutive quarter. Think about how incredibly hard it is to maintain that kind of efficiency and margin growth at this massive of a scale.
Plus, they aren't just looking backwards. The Q4 guidance is an absolute blowout, too. They are forecasting $10.25 billion in revenue for the next quarter. That represents a massive 51% annual growth rate. Oh, and they expect EPS to jump to $4.02, which is an 85% surge year over year. By basically any traditional metric, this is a masterpiece of a quarter.
Okay, let's dive into this, because right here is where the story twists. Despite printing these absolutely perfect metrics, the stock closed down over 5% at $507.18. Actually, it now sits 31% off its June high of $739. How does a company report its best quarter ever and lose almost a third of its peak value in just a matter of months? Well, let's put on our detective hats.
Section 1. Investigating the sell-off. Let's uncover exactly why the market punished perfection.
We can really break this down into three core culprits. Number one, sky-high expectations. You see, Applied Materials stock had already more than doubled this year leading up to this report. So the market had already priced in a flawless performance. They expected perfection, they got perfection, but they didn't get anything more than perfection.
Our second clue is margin stagnation. Despite that massive expected revenue growth we just talked about, Q4 non-GAAP operating margins are actually expected to stay completely flat at around 50.4%. No margin expansion moving forward is exactly the kind of thing that spooks growth investors.
And the third reason is arguably the heaviest: China exposure. Revenue from China dropped to 28% of their total, down from 32% last quarter. Now, even with that drop, that is still a huge chunk of their business, meaning ongoing geopolitical tensions and export restrictions remain a very real, very heavy overhang on the stock's valuation.
Then there's this fascinating little detail. Over the last 3 months, company insiders sold roughly $170 million in shares, with absolutely zero insider buys. Now, it's important to state this isn't necessarily a panic signal. Executives sell stock for lots of normal reasons. But when you have zero buys during a pullback, well, it's definitely a data point the market takes note of. Let's move on to the valuation reality check, because we really have to look at both absolute and relative pricing. To really grasp what's happening, we have to look at the current numbers. In absolute terms, the stock is undeniably expensive. You've got a current price-to-earnings ratio of around 43.8, and a price-to-sales ratio sitting near 13.1. Historically speaking, for this specific company, these are very elevated high-water marks. But here's the nuance, and this brilliantly illustrates exactly why context matters. When we project into the future using forward PE, Applied Materials sits at 32.1x. Compared to its major peers like ASML at 33.4x, Lam Research at 34.6x, and KLA, which is slightly higher as well, Applied Materials is actually the cheapest value play in the entire group. Wall Street analysts clearly see this relative value too. The average analyst price target for the stock is currently around $637. Even the more conservative targets, like Craig Hallam at $585, are well above the current trading price. With UBS at $675 and Needham at a highly optimistic $740, that average target still implies about a 19% upside from where we are right now.
Which brings us to the competing narratives driving the market right now.
Right now, there are two completely opposed narratives going head-to-head. On one side, the bulls argue that the AI infrastructure expansion is still in its very early innings. Applied Materials is essentially the picks and shovels provider for the AI gold rush, boasting a massive return on equity of about 41%. On the flip side, the bears argue that the valuation is simply stretched too far. Geopolitical risks with China aren't evaporating, and fair value models suggest a potential downside of 20 to 24% if there's any macro or AI capex pullback.
To really understand the strength of that bull argument, CEO Gary Dickerson recently noted that leading-edge logic, DRAM, and advanced packaging will drive roughly 80% of wafer fab equipment growth through 2027. In fact, their advanced packaging revenue alone is projected to surge over 70% in calendar year 2026. I mean, that is a colossal secular tailwind that really shouldn't be ignored.
And finally, the verdict. What can we actually take away from all this data? So the crucial point is looking at these strict technical levels. On the upside, we have resistance at $554.94. If the stock breaks through that, the next targets are $582 and $613. On the downside, support is sitting right at $502.52. If it falls below that, the next floor drops to $465.90. The reality is, despite incredibly strong fundamentals, this stock remains highly vulnerable to market sentiment.
Which leaves us with the ultimate question. Do you buy the dip or do you fade the rally? For long-term investors looking to play a massive secular growth trend, this dip might look very attractive. But for the traders out there, you might want to wait for technical confirmation above that resistance line first before jumping in. So, what's your take? Is this an overreaction by the market or a perfectly justified correction? Drop your thoughts in the comments, and I'll see you in the next explainer.